Welcome. In this video, we will analyze what will happen next for Xcn coin. Don't forget to subscribe and like, and please watch to the end to understand. According to Elliott wave theory, we can say that the market is currently under the influence of a third wave movement. As you may know, third waves are typically where the strongest and most high-volume bullish moves occur. This phase is characterized by rapid price acceleration and growing investor confidence. And if this analysis holds true, we could be looking at a significant upside opportunity. What's more, this potential is supported by clearly defined targets based on Fibonacci levels. At the moment, the price action on the chart is forming just above a key Fibonacci level, represented by the green line. This area may have previously acted as both resistance and support, making it a critical zone. Holding above this level is a strong signal that the trend remains intact and that buyers continue to dominate. If the price can maintain stability above the green line, the next target becomes the blue line, another important Fibonacci extension level, and a potential resistance zone from a technical perspective. However, by nature, third waves are expected to break through resistance levels. That's because this phase often aligns with peak bullish sentiment and strong buying momentum in the market. So while the price may pause or consolidate near the blue line, a breakout above it, backed by strong buying volume, becomes a highly probable scenario. If that happens, the next major target would be the purple line. The purple line may represent the potential maximum extension of this third wave. It's a key area derived from both Fibonacci projections and historical price action, making it a critical technical level. If the price reaches this region, it would confirm that bullish momentum in the market is not only intact, but accelerating. Reaching the purple line would also reinforce investor optimism, which can further fuel upward price movement. In third wave scenarios like this, one of the most important things to watch is whether the price can hold above previous Fibonacci levels. Right now, holding above the green line is crucial for the continuation of the trend and for gauging overall market sentiment. If the price avoids closing below that level and instead starts moving upward with strong volume, it becomes likely that we'll first see a test of the blue line and eventually the purple line. In conclusion, based on the principles of Elliott wave theory, the current third wave phase presents significant opportunities from a price perspective. The fact that price is currently holding above the green Fibonacci level suggests the structure is healthy and that there's increasing potential for further gains. While the blue line stands as the first target, a break above it could pave the way for a move toward the purple line, a technically realistic scenario. That said, it's important to remember that relying solely on Elliott waves isn't enough. We need to consider other metrics and confirmations as well. Stay tuned and keep watching. One of the most notable aspects of the current chart is a specific price level that has historically triggered strong reactions. This level hasn't just been tested once, it has been revisited multiple times, each time resulting in a significant buying response. In technical analysis, such levels are commonly referred to as key support zones. These are areas that attract the attention of a large number of market participants and play a crucial role in decision-making processes. The price range that previously saw strong buyer interest may once again trigger a similar reaction if revisited. This is especially important in technical analysis, where the concept of support turning into resistance, and vice versa, is highly relevant. Levels where bullish moves have previously started often serve as potential launching pads for future rallies. These zones are also closely watched by investors and trading algorithms alike, and they tend to attract high trading volumes. A bounce from such a level backed by volume is a sign of strength, while a weak or low volume reaction could signal a short-lived move. That's why it's essential to watch not just the level itself, but also the volume and candlestick behavior around it. To better understand the strength of this support zone, it's helpful to look at how price has behaved near it in the past. For example, previous visits to this area were often followed by consolidation, and then strong bullish moves confirmed by solid green candles. This suggests that market participants may view this level as a fair value, or even a local bottom. Such psychological perceptions can lead to similar behavior if the price returns to that area, as traders recall previous profitable reactions. That said, it's important to acknowledge some key details here. Technical analysis operates on probabilities, not certainties. Just because a support zone has held in the past doesn't guarantee it will hold again. For that reason, decisions shouldn't be based solely on the support level itself. The overall price action and broader market context must also be considered. For instance, if the market is in a downtrend and trading within a descending channel, any bounce from support might be short-lived. On the other hand, if this is a retracement within an uptrend and the price pulls back to a strong support zone, the resulting buying momentum may be more sustainable and powerful. A pullback toward a key support level can be seen as a buying opportunity by some traders, while others may view it as a high-risk area. This is where individual factors such as risk tolerance, trading time frame, and overall strategy come into play. Some traders prefer to enter positions directly at support, while others wait for confirmation signals, such as a clear rejection or bounce, before committing. Candlestick formations at the support level can provide valuable clues. Patterns like pin bars, bullish engulfing candles, or volume-backed reversal signals can all help gauge the strength and sustainability of the bounce. These zones are also often on the radar of large institutional players. In fact, many institutional buyers wait for price to pull back into major support areas before initiating high-volume entries. When you see a sudden spike in volume as price approaches a support level, it can be a strong indication that institutional money is entering the market, which in turn reinforces the strength of the support and increases the likelihood of a reversal. Support zones matter not only from a technical standpoint, but also from a psychological perspective. Traders tend to trust levels that have worked well in the past. The mindset of "this level worked for me last time" can trigger renewed buying interest. This collective trader psychology is a key reason support levels often hold. In conclusion, closely monitoring price behavior around this support zone is essential when planning a buy or sell decision. A support level alone may not be enough to justify a trade, but when combined with sound analysis and a disciplined strategy, it can offer significant opportunity. If price revisits this area, a bullish reaction is highly likely, because historically, this zone has attracted strong buying interest and acted as a trusted level for many market participants. The current outlook of the MACD indicator signals that bullish momentum in the market is steadily strengthening. In particular, the fact that the MACD line continues to stay above the signal line and that the gap between them is widening suggests that momentum is increasingly favoring the buyers. If this positive momentum continues, there's a high probability that the price will follow suit with an upward move. In technical analysis, the direction shown by indicators like MACD often precedes actual price movement, especially with trend and momentum-based oscillators. MACD, which stands for Moving Average Convergence Divergence, is based on the principle of convergence and divergence between moving averages. This indicator not only measures the momentum behind price movements, but also provides valuable insights into potential trend reversal points. The current upward slope of the MACD line indicates that bullish momentum is building, which in turn suggests that price may attempt to test higher levels. In such scenarios, price often follows the MACD, meaning that as the MACD line trends upward, price tends to follow a similar upward trajectory. This correlation exists because the MACD is derived from historical price data. Any acceleration or deceleration in price action directly affects the direction of the MACD lines. Therefore, when MACD is trending higher, it usually indicates that the price has already been moving upward and still has the potential to continue in that direction. However, it's important to note that price doesn't always move in perfect sync with the MACD. In some cases, the MACD can remain in positive territory, while the price enters a consolidation phase or experiences a pullback. These situations create what's known as a divergence between the MACD and price action, a signal that requires careful analysis. But in the current setup, both the MACD line and the histogram are supporting the bullish move, making the short-term outlook lean clearly toward the upside. For this bullish scenario to remain intact, the MACD line needs to continue diverging clearly from the signal line. This separation reflects ongoing buying interest in the market. If previous bullish runs were preceded by a similar MACD formation and were followed by strong upward price movement, then this current pattern may also fall under what's commonly referred to in technical analysis as a repeat behavior tendency. Yes, friends, this is how it happened in this video. Don't forget to subscribe and like. Goodbye.